If you earn a wage in Australia, the government is about to hand you $1,000 off your taxable income with no receipts required. And here's the catch. Most people will take it the wrong way and quietly leave hundreds of dollars on the table every single year. From the 2026-27 financial year, around 6.2 million workers can use a new instant deduction, budget 2026-27. But the government only expects an average saving of $205, and there are 3 legal moves that turn that into a much bigger number: claim, log, and deduct. Here's the figure that should make you sit up. In 2024 to 25, Australians claimed $31.1 billion in work-related deductions across 10.1 million people. ATO, via ABC News Tax Time 2026. That's about $3,100 each. But here's the part nobody tells you. Millions still miss legitimate claims entirely. 3 moves today. Claim the $1,000 deduction and then itemize above it. Log your home office hours at 70 cents each and turn your super into a tax deduction. Let's start with the first quiet money drain, underclaiming. From 2026-27, you can knock $1,000 off your work-derived income with an instant deduction, no receipts needed. Budget 2026-27. The problem is it's designed as a floor, not a ceiling, and most people treat it as the whole story. Watch what the numbers do. At a 30% marginal rate, a full $1,000 claim saves you $300 in tax, but Treasury's own budget materials show an average saving of just $205. Budget 2026-27. That gap means many workers are pocketing the default and skipping the extra they're entitled to. The second layer is super. You can make personal contributions from your after-tax money and then claim them as a deduction by lodging a notice of intent with your fund. ATO super rules. Inside super, those dollars are taxed at just 15% instead of your marginal rate of 30% or more. Here's what doing nothing costs. A worker on a 30% rate who puts $5,000 into deductible super saves about $750 in tax that year. ATO super rules. And if your spouse earns under $40,000, a $3,000 contribution can earn up to a $540 offset, money simply left unclaimed. Now the belief that stops people cold, that claiming lots of deductions just invites an audit, so it's safer to claim little. The ATO targets private expenses, not genuine work costs, and 10.1 million Australians claimed $31.1 billion last year, ATO. The risk is claiming what isn't yours, not claiming what is. Put both problems together and the cost is real. Not itemising beyond the default costs about $450 a year, and skipping deductible super costs another $750. Budget 2026-27, ATO. That's roughly $36,000 over 30 years before any compounding. Meet Emma. She's 35, a marketing manager earning $95,000 with $80,000 in an industry super fund and 30 years until retirement. She works from home 2 days a week and pays for work costs out of pocket, but she's nervous about claiming after the ATO crackdown headlines. Emma's first discovery cost her $450 a year. When she added up her real expenses, home office hours, phone, professional fees and equipment, she had $2,500 of legitimate deductions. Budget 2026-27. Taking only the $1,000 default left, $1,500 unclaimed, and at a 30% rate that's $450 handed straight to the ATO. Her second discovery was hiding in her calendar. Emma works from home about 800 hours a year, and at the revised fixed rate of 70 cents an hour, that's a $560 deduction, ATO 70C fixed rate. At 30%, that saves about $168, money she'd left behind purely because she never logged her hours. Her third discovery was the biggest. By contributing $5,000 to super and lodging a notice of intent, that money is taxed at 15% inside super instead of 30%. ATO super rules. That's $750 saved every year, about $22,500 over 30 years in tax alone, plus decades of growth. Add it all up, and Emma's career gap is striking. Roughly $1,200 a year in avoidable tax times 30 years is $36,000, author's estimate from ATO and budget figures. And that's just the tax. It ignores the compounding on every extra dollar inside her super. So could this be you? You've never itemised beyond a rough deduction figure, you don't track the hours you work from home, or you've never made a personal deductible super contribution. If any of those sound familiar, the next 3 moves are exactly for you. These 3 moves are all legal, all backed by the ATO, and together they can redirect over $1,000 a year from the tax office into your own pocket and super. None of them takes longer than a coffee break, and you can set them up before your next return is due. Move 1. Claim the $1,000 deduction and then itemise above it. In My Tax, take the instant deduction if you're eligible, then work through the categories like car, travel, clothing, and self-education. ATO My Tax 2026. The goal is for your total to reflect what you actually spent, often well above $1,000 if you work from home. Log into MyGov and open your My Tax return. Select the $1,000 instant deduction if eligible, then add your itemised expenses above that threshold with receipts. You've done it right when your deductions match real spending and you can prove every single one. Move 2. Log your home office hours and claim them at 70 cents each. Keep a simple diary of the dates and hours you work from home, then multiply your total by 70 cents using the ATO revised fixed rate method, ATO 70C fixed rate. For someone working 800 hours, that's $560 you'd otherwise miss. Start a timesheet noting the dates and hours you work from home, multiply your year-end total by 70 cents, then enter it under work from home expenses and keep the log. Good looks like a clear record. 800 hours times 70 cents equals $560 that you can justify. Move 3. Turn your super into a tax deduction. Transfer an affordable amount, say $3,000 to $5,000, into your fund as a personal contribution, then lodge a notice of intent to claim a deduction before you file ATO super rules. Once the fund acknowledges it, claim that amount in My Tax, and it's taxed at 15%, not your marginal rate. Transfer $3,000 to $5,000 to your super as a personal contribution, lodge the notice of intent and wait for written acknowledgement, then claim the acknowledged amount in My Tax. You've nailed it when your fund taxes that money at 15% instead of your 30% plus rate. Here's why now matters. In 2025-26, the low-income Medicare levy thresholds rose by 2.9%, lifting the singles threshold to $28,011, William Buck. In 2026-27, the $1,000 instant deduction arrives for 6.2 million workers. Budget 2026-27. And in 2027-28, a permanent $250 working Australians tax offset begins. After you act, check 3 things. You should see your full deductions itemised in your My Tax summary, confirm your fund acknowledged your notice of intent in writing, and if your refund went up or your tax payable dropped, your claims landed correctly. That's your proof it all worked. Everything you've heard today comes from the ATO's My Tax 2026 instructions. The federal budget 2026-27 cost of living materials, William Buck's budget analysis, and ABC News reporting on tax time 2026. All of the links are in the description below so that you can check the figures yourself. So now you know the 3 moves. Claim and itemise, log your home office hours and deduct your super contributions. Next week, we're digging into the super contribution mistakes that quietly cost Australians 6 figures by retirement, so make sure you don't miss it. If this saved you even one trip down the ATO website, do one thing for me. Hit subscribe so the next breakdown lands in your feed. We read the fine print so you don't have to, and there's a new one every week.